All right, that's cool. Hello, my dollar. Welcome to the live. Yeah, I'll work with that one. Okay. Hey, welcome to the live. Ifi 2024, welcome. Baban Hanan, welcome. Candid Winstone. If that's not your real name, it's a little too obvious. Mabashi Mane. I hope I'm not mispronouncing that. Hi, welcome to the live. Baban, thank you for the like. Komeski Jr. Okay, welcome. Mabashi Mane. I hope I'm not mispronouncing your name. Let me know. I like pronouncing people's names correctly. We're starting in 3 minutes. Franklin 71, hi. Rogue Introvert, hi. 400, you're welcome. We start in 3 minutes. So typically we start by 11. I'm just waiting for the regulars to show up if they are showing up on time. 400, thank you for the like. Kaminsky Jr., thank you for the like. Fidocam, thank you. God, are big. Some of y'all with these names, I love it. 2 minutes. Good evening, Godabeg. How far now? Hope you're doing good. Hope everybody's trading today made sense. Baban, thank you for the rose. I appreciate you. And thank you for sharing the live as well. Thank you, thank you, thank you, thank you. I appreciate you. I appreciate you guys. You don't have to, but you do it, so I appreciate you. Thank you for the rose, Baban. Hey, Baban's showing me mad love today. That's nice. 234, God, I beg. I am very Nigerian. It's just that when I'm presenting, any accent you want to take, we'll collect like that. 1 more minute. Hey, Freddie's in the room. Freddie Black in the building. Fidocam, thank you for the live, for the like rather. Freddie Black, thank you for the like. I see you. I see you. Less than a minute, maybe just a few seconds. I greet you too, Freddie. Freddie's just killing it. Freddie, please give me signals. I'm actually begging. I'm very sorry I said I won't give signals. I hope that doesn't offend you. Give me signals though. Thezome, I don't know if I'm pronouncing your name correctly. Welcome to the live. If it's any comfort to you, I'm down like 0.5% today. So we'll make it back, don't worry. Freddie. Wahala. Don't go and open signal service. Eh? I'm telling you, Neo Easy. Freddie is a beast. Freddie is with the charts. He's just, yeah, no, it's mad impressive. It's mad impressive. Tezome, I hope I'm pronouncing your name properly. But yeah, I'm glad you feel better. Listen, losses happen. I lost today and I was very, very pissed off. I almost actually lost my shit. For all my coming on here and telling you guys don't get too attached. I'm human too, it happens. You know, we'll get it back. We'll get it back, okay? We'll get it back. All right, it's 11. Before I turn this camera around and talk about the same thing over and over and over again, which those of you who already know me, you're probably, I don't know, are you bored? I feel like 1.7 likes and 17 people in the room. Interesting. 17, 17. I'm kidding. You're sad for me as well. I got over it. I got over it. And it has nothing to do with the food I ate in the morning. For those of you saying something happened on the charts, it happened after the food. And there's no connection there. Don't stress me. Before I flip this camera around, okay. No, but Freddie, you're on something else entirely. I really, really, really enjoy your style. I like what you share in there. Okay. Nobody has anything they want to ask before I turn it around. I'm here. I want to answer your specific questions because I keep talking about the same thing anyway. I thought that I would ask and check in. Miss P Official, if you're here, hi, welcome to the live. Just Amin, welcome to the live. Thank you for the likes as well. Do you do love trade? Oh, you mean live trades? Hey, not me already thinking, do I have to, do I do live trades? No, because the reason for everything that I do is from personal experience. I remember one time ICT was trading live and he actually made money. I lost money on that same trade. And I look back now and I realize it's because I didn't really, I understood. Then I was understanding liquidity as a strategy. So I understood it, but I didn't understand what the hell was going on. So I'm not doing that. I'm not doing that at all. And part of what slowed down my growth actually was looking for live trades, looking for signals. I'm not trying to put you down for this one. It's okay. If that's what you want, it's fine. It's just that it made me feel a little bit more. I didn't have that confidence. So I had to start looking for things myself and teaching myself. Let's see what we got. Nice has a question. Nice, let's go ahead and ask your question. Bab and Hanan, brief explanation about order block. Okay, so that's part of what we'll cover. We cover it every day. We'll cover it again today. So when we get to the order block portion, you'll learn. When do we know the market will stop at half FVG or go for the order block instead? We don't know. We trade what we see. At least let me speak for myself. Maybe you have a way of knowing. I don't. I don't know. I just trade what I see. I see the market's at the FVG. I see that it's retracing into some internal liquidity or external or whatever criteria. And then I'm waiting for breaker market structure and I'm in. So I don't know. And I'll be frank with you, actually, part of the reason I even lost is because I deviated a little bit from what I typically do, which if you've been with me from the beginning, I've always preached about wide stop losses. I'm that kind of trader. I don't mind having a 50 pip stop loss. And I don't mind, and this is not advice for you to take, okay? I don't mind having a 50 pip stop loss and having a tighter take profit because I'm trading based on liquidity. It means my win rate will be higher, but I also recognize there are times when the market does not push all the way for like a 1-to-1. So I'm not really interested in that because my win rate is high, because I don't trade too often. I'm not worried about having that skewed negative risk reward ratio. So nice. Anyway, I hope that answers your question. I cannot predict and not everything works all the time. Okay? So you just have to look at what's there. Do I have life course? Like a live course or like a life about life? Desome, help me clarify, please. GTG Exchange, thank you for the follow. Freddie Black, exactly. Don't make it complicated. Skyfer, welcome to the live and thank you. I see you. Nice. Yes, what was that in response to? Okay, I think I've already answered your question though. I've been studying a few minutes to 1 hour now and I went to the chart and I was a bit confused. What was confusing you, Freddie? You. Freddie, you did why me? You did why me? Can we trade with you or send notifications if I pay for your course? Okay, so this is the thing. I don't offer a paid course. At least not right now. There will come a time, and I'm starting to approach that time. I'm starting to have a lot of other things that I need to do, which means one of two things. Either the lives will have to be earlier, or I will have to remove a few more days because I have other things I have to do. And I value my sleep. My sleep is necessary for good trading. So I don't have a course. What I do have is one-on-one mentorship, which I am closing in, it's now the 24th. I'm closing at the end of the month. So I said already I have one person. And if that one person's all I have, then that one person's all I have. And that's because I don't like stress. I don't like stress at all. I would rather deal with a few people. I'm not interested in trying to micromanage too many people. And as for trading with me, that is signal adjacent. And if you know anything about me that I keep saying here, I don't do signals. I don't give signals. I train you to be your signal provider. Jam packing stuff doesn't help me, but you're still inquisitive. Believe me, I know what it's like, especially when trading is not just about making money to you. It's actually, it's like it's in your blood. It's like a calling, like a passion. And then you start going to study all kinds of things. So for me, the discipline is reminding myself consistently that yes, I know a lot of things. Some of the things I have not shared on here and have decided I will not share. Not because I'm trying to gatekeep, but because I don't want you to deal with that same issue of being confused because you know too many things and now you see so many different kinds of fair value gaps and so many. We simplify. So Tezome, I hope that answers your question. Freddie Black, I've answered you as well. Tezome, you have a lot of cash, 200 to 500K. You should not be making that announcement in spaces like this. I can guarantee a scammer is going to contact you. So this is my live. I try my best to keep it as safe as possible, but I've started to notice that they have started to notice me. And so I get some weird comments on my videos from scammers, and there's someone on here that was even trying to pass themselves off as me in my own live, which is wild. So please don't make such announcements because you're going to have people. How do I delete that? I can't delete the comments. I'm not about to start figuring that out now. So anybody reaching out to you claiming to be me, it's not me, guys. It's not me. Carrion Season, welcome. Hit the like button, Sky. Please at least consider live trading. It is signal adjacent. I've said multiple times. I'm not going to do it. And also, there's a selfish reason I won't do it as well. I do not want the pressure of other people's expectations. Trading is a very personal journey. It's a very personal journey. I will show you how to fish. Go fish for yourself. All right? I don't want to start thinking about, it's enough that I have obligations I have to fulfill. I've told some of you that I actually have some things I got to pay off. I got into a lot of hot water on account of this. So there's stuff I have to pay off. That's enough pressure for me. There's things I would like to do for people in my life. That's enough pressure. I don't need the added pressure of trying to give you signals. I don't want that. Yeah, definitely join the Telegram group actually. It's in my bio. Link is in my bio. It's called Tick Takers. Just in case they have created another one, please just go through my bio. Okay. Seems no more questions, but I do see some new people have come in. Williams, I see you. Hi. Patty, welcome to the live. Some of you have cash only. Stop making that announcement, my boy. You're going to have some very strange people contacting you. Please, don't give your money out to anyone to trade for you. I would prefer that you learn yourself. If you're going to give it out, it has to be someone who's actually certified to do that. Someone that you can report to the authorities with ease. Williams, hi, good evening. Okay, so if there's no more questions, I'm going to flip the camera around in 10 seconds. 9, 8. Telegram link is not opening. Could you do me a favor? Copy the link. Richard Dawinja. Hang on, let me just type it in here, but you can just copy the link from my bio, open it in your browser. Let me put the link on here. t.me/tick-takers. All right. Thank you for the likes, guys. I see you. Yeah, Telegram's not going to let me pin that, but that's the link. TikTok is not letting me pin it, but that's the thing there. Because if you've joined, I don't know who. I can't connect you with your username. You probably don't say a lot in there. So just chat shit. Daniel of Fitness. Hey, a woman with a dread. Damn, what's up? Appreciating your content from Kenya. DeLuca, thank you very much. Big Six, hi, welcome to the live, guys. So I said I was counting down 10 more seconds and then we go to charts. 10 more seconds for any questions you want to ask. 9, 8, 7, 6. Yusufa, welcome to the live. 4, 3. I'm Nigerian. 2, 3, 4. 1 and 0. Let's flip it around. It's time. I gotta make that clearer. Much better. Also, this is definitely not what I want to use. Come closer. Okay, all right. Give me a moment while I change the template. Where is my template, by the way? TikTok blue, I have this other, yeah. I think it's this. Yes, this one. Okay, it's the same shit every day. Those of you who are familiar with me, you already know what's up. And those of you who are not, hi, my name is Nessa. Also, I take ticks on TikTok. This is my only account. All right? And what I'm going to do today is talk to you about liquidity. Liquidity is simply a fancy word for money. And money is your business. When you come on the charts here, what you're looking at really you must think about is the movement of money. We say it's the movement of price, but if you think about it as money, I think that narrative is going to help you immensely. So let's talk about those of you who are expecting me to look at specific charts. It's not going to happen. It's not going to happen until I have explained everything. Then maybe if I have time, we'll look at charts. But I'm here to explain the concept first of all, so that those who don't get it, or who haven't heard me before, or who have heard but they don't really understand some things, they have another opportunity to hear me once more. I believe in repetition. It's an excellent way for you to learn. So let me grab my text box here, and I'm going to, as usual, adjust that to be bold and to put it at a 16-point font. All right, cool. So to master trading, I don't like that. That's too dark. All right, much better. Also, there's something off about this. There we go. To master trading, your job is to ask yourself 3 questions. Okay? In bracket, after figuring out the trend, of course. So question number 1, where is the money coming from? Question number 2, where is the money going to? And question number 3, is there enough room, y'all know this by now, between both places to take some for myself? Whenever you open a chart, these are the 3 questions. Why does it matter? So let me zoom out and show you all of this. We're just moving back and forth. That's a lot of data to consider. It's a lot. It's easy to get lost. It's so easy to get lost. Pretend any of these parts here is the hard right edge of your your trading chart, and you have no idea what's coming next. It's easy to get lost. That is why we have these three questions. If we do not have the answers to these three questions, we do not take a trade. This is like real life, okay? In real life, you'll find that as much as you have freedom to be, do, and have whatever you want to, if you don't have restrictions in place, your freedom is a recipe for disaster, for destruction, for catastrophe. It's the same thing with trading. You have so many pairs available, but if you do not restrict yourself to a few, you're going to scatter your energy, your attention, and you will not get the best results. And it's the same thing even when you're dealing with a single chart. If you do not have these specific price points that you should be concerned with, you will be lost and you'll make decisions that don't make sense. And when those decisions actually play out in your favor and you make money, it's going to be more likely luck than skill. And then it's going to bite you in the ass eventually one day. And I'm telling you this because I know, because I've been there, not because I'm judging you. Okay? So let's talk about what these questions imply. They imply that there is a starting point and a finish point that you should be concerned with when it comes to your setup. They also imply that there has to be enough room between, or enough pips between these points on your chart for you to be able to take some of those pips for yourself. So, in other words, when I talk about these three questions, what I'm really talking about is something called the range. And typically when you hear about range, we talk about stuff like Asian market, the Asian session, the, London session, New York session, like those trading ranges, or we talk about the daily range and the weekly range and all of that. But I want to tell you, I'm trying to show you how to think. I'm not telling you what to think. I'm telling you how to think so that you yourself can use whatever criteria you personally prefer to define what counts as a range for you. So what is a range? A range is the distance, or rather the area between two price points. It doesn't matter if that area is only 1 pip. It's still a range. Okay? So I'm going to slide this off to one side here. And let me grab a horizontal line so I can show you practically what I mean. So here we have 2 lines. All right? These are 2 lines on the chart. This area between the 2 lines, that is a range. Think about what a range actually means in English. It is a series of things, a series of a similar thing. The similar thing in this context is price. You're looking at a chart, you're looking at prices from here to here. So even if the distance between those 2 lines is just a tiny little measly pip, guess what? It's still a range. But the problem with having a range that is that tiny, or a range that is only maybe 5 pips or only 10 pips, especially if you're not a scalper, the problem with that is you don't have enough room to make money from the range. Because remember the questions again. Let's bring it here so you can see. I said to master trading, your job is to ask yourself 3 questions after figuring out the trend. Number 1, where is the money coming from? Where is the money going to? Is there enough room between these 2 places to take some for myself? And these 2 places, they bracket the range. In other words, let's come back to these 2 lines here. Look at these lines. This could be where the money's coming from and where the money's going to, or vice versa. This could be where the money's coming from and where the money's going to. It all depends on the trend that you are trading in. Okay? So why am I specific about talking about ranges? Because that's how you find the money. The money's either inside the range or just outside of the range. If the money's traveling too far away from the range to the top side or too far away to the bottom side, then you have no business. The only time you may have business with this range once more from the outside is if maybe there's a break in market structure that makes it very obvious the market wants to trade back into the range. So let me explain something about when price is in a range, okay? Typically, and not all the time, I need you to note this, okay? Not everything, I'm going to flip this so you see my face. Not everything happens 100% of the time in trading. Not everything happens 100% of the time in trading. I don't care who you learn from. If they tell you they have a strategy that works all of the time, they're lying. They want to take your money, or they're still learning and they're trying to pass themselves off as someone who actually knows what they're talking about. Nothing works out 100% of the time. What you are in the business of is the business of probability. So, as a trader, you understand there is a probability that a setup you see may play out or not. When you operate from this premise, you stop doing things like risking too much or taking too many trades or trying to stifle your trades or not give them enough room to breathe, because you know that that would just be reducing your odds, reducing the effectiveness of your edge. Okay? So let me flip this around back to what we're talking about here. So let me adjust this better. The money typically lies inside of the range and outside of the range, just outside, not too far away, okay? Not too far away. Now, typically, if the market comes to take out a high first, when you have a range, the market takes out a high first, the odds are it's coming back down to take out the low, or at least coming back down to 50% of the range. Remember, probably, okay? The odds are, I'm using these words, very specific words, for a reason, to get it into your brain that I'm not saying this happens 100% of the time. Similarly, if the market is taking out the low first, as in trading out from the range through the low, the odds are it may want to go back in and clear at least the halfway point of the range or higher, the other side. Okay? This does not happen all the time, but this is just basically something to keep in mind, and I will show you examples of it. So let's talk about how you can define a range. I said it is the difference, the area between two price points. Now, what do I mean by that? There's many ways you can define a range. Let me just write that out and then we'll start looking at it. So here, you can define a range as, let's see, types of ranges. I'm just going to put this here. Types of ranges. Number one, a single candlestick or bar. Okay, for those of you who use range bars or Renko bars. Range bars and Renko bars, or your regular candlestick. Number two, you have from swing to swing. And I'll explain that in a bit. Okay? What other way is there? I'll get into other ways, but I think that for now this will do. So when I say from swing to swing, I have to define for you what a swing is. A swing is literally the turning point in price. So we identify swings easily on the charts, but we don't really think about the meaning of the words we use, or at least some of us don't. When we say it is the turning point in price, a swing is quite literally where the market from this point here has been pushing down, and then it literally turns around. But how do you define what the actual swing is? It is a 3-candle pattern. So let me show you a clear example here and zoom in. You have this 1, 2, 3. In a 3-candle pattern of a swing low, which is also a bullish swing, the middle candle has the lowest low of all the 3 candles. Okay? Here's another one. 1, 2, 3. The middle candle has the lowest low price of all the 3. Here's another just here. 1, 2, 3. 1, 2, 3. Okay? Conversely, you have swing highs. 1, 2, 3. The middle candle has the highest high of the 3 candles. All right? So that is formed and then it pushes. Look at another one here. 1, 2, 3. All right? So remember how we define a swing, because it is key. It is literally the turning point in price. Now, if you are a scalper, a 15-minute swing may hold significance for you. But if you're a day trader, a swing trader, position trader, then swings would be even more significant on a higher time frame. So this is USD CAD, and this is a high time frame. This is a daily swing. 1, 2, 3. And think about how, as soon as you have the swing formation, which is not all the time, mind you, this doesn't play out all the time. One of the things you can do is you go down to a low time frame and wait to see if you can get breaks to the low. So when this day, and this day have closed, this one closes here, you now have that swing. For the next day, all you're doing is waiting to see on a lower time frame, like maybe the 15-minute or 30-minute, if you get a significant break to the downside. If you can get that break to the downside, then that could be your bread and butter. It could be that simple. You're just waiting for swings and looking to take advantage of them. Similarly, yesterday created a swing low, 1, 2, 3. Okay, so we're talking about how to frame your ranges. You could frame a range based on a single candlestick, even if that candlestick is a 1-minute candle. But I don't recommend it because the 1-minute candle does not have as much movement as a daily chart. So this is a daily chart. Measuring all of this from here to here, you have about 65 pips or 62 pips. This is USD CAD. But if I take you to a 1-minute chart, and I measure something, look, this looks really big, right? This looks like a huge candle. But if I measure from here to here, it's only 10 pips. So unless you're a scalper, this should hold no interest to you. This is why, remember, again, the questions. Where's the money coming from? Where's the money going to? And is there enough room between the two places to take some for myself? So essentially, every candlestick has an open, close, a high, and a low. If you want to, you could use the opens and closes as a range. I don't. I use the entire thing, which means I use the high and the low to define my range. And in this particular example, if you think about what I said before, look at this bar here, it closes. What happens to the low? The low gets taken, and then what happens? The market starts to pull back in. If we measure from here to here, let me pull my Fibonacci so we can see. From here to here, what has the market done? It retraced into 50%, the 50% portion of this range, this day's range, because that's a daily bar, okay? I'm not saying it always plays out perfectly like this. I'm pointing out stuff for you to notice. So if you want to, you can pick a 4-hour candle and say, yeah, I'm going to use the 4-hour as my range, okay? Now, there are two kinds of liquidity, because we're really talking about ranges only because we are trying to locate this money. The money there, if you've ever heard the word liquidity, it's really just a fancy word for money. That's all it is. And your job as a trader is finding the money. And I like to give this analogy, a money heist analogy, right? So let's say I'm going to grab a rectangle here. And let's say that this red rectangle over here is a mint. And this is a bank. Okay, I don't know where you guys all stay, but I'm just trying to give an example. Let's say I'm going to use Lagos for those of you who are familiar with Lagos. So let's say that the mint, where the money is being printed, okay, because money has to be printed at a mint before it's distributed to the banks. The mint is somewhere on the mainland, just as an example. And then the bank that it's supposed to get to is on the island. So there is a lot of distance that has to be covered before the money can make it to the bank. There's so much distance. There's a lot of twists and turns and all of that. They will have to have a lot of security accompanying that bullion van. And yet, despite all the security, there's nothing they can do to stop a very determined person from jumping them in the middle of their transportation, collecting some of the money for themselves, and then taking off. That person is you. In this case, that's your job as a trader. So this is the mint, meaning the money's coming from here. And so you want to be able to get in here, take some along the way, and then hop out. Don't follow the bullion van all the way to the bank. Because at the bank, I promise you, there's probably security waiting for you or police waiting to take you, if that makes sense. Same thing if the mint is here and the bank is here, whatever. Now, if you have a situation where this is the mint and this is the bank and the distance between them is just here, like this, for all you know, they don't even bother trying to come up to the surface. Maybe they have an underground tunnel, so as soon as the money's being printed, they just move it through there. And even if you know about the tunnel and you're hoping that maybe you can take some for yourself, you're very likely going to get caught. You're going to get caught in that, which means no money for you and prison time. Okay? So that's the same analogy. when it comes to charts here. You're looking for something that gives you more than enough room to exploit. And we're talking about how to define a range. So I've defined for you what a swing is. I said it's a turning point in price. And what you're looking at right now is the USD CAD on the 4-hourly chart. 1, 2, 3. This is a swing high, all right? Or a bearish swing, if you will. 1, 2, 3. This is a swing low. As the market starts to push up into here, automatically you now have a range, and I will draw it out for you. Hang on a sec, let me grab a rectangle. From here to here, I need to make that white and transparent. And zoom in a bit. So from this point here, down to this point here, you have defined yourself a range using swings, okay? So it's not just random swings, it's you have a 1, 2, 3 swing, and then the next candle after that third candle shows you a willingness to push in the same direction as the swing, to continue in that direction. And then when the market arrives, you may see a swing before this point here, but as long as the market did not show you that willingness to continue pushing back up, then you don't have a bottom for your range yet. So once it starts to make this retracement, now you have defined yourself a range, okay? You could also define each single candlestick as a range. If you use range bars, quite literally, they are called range bars because they are measured. Each bar is a range of prices. So this one I'm about to show you is a 20 pip range bar chart, which means that each of these candlesticks is worth 20 pips, which means that unless the price moves 20 pips from a low here up, it's not going to create a new bar, even if many hours pass. For the bearish bars, unless the market pushes 20 pips from the high, it will not create a new bar. And the result of this is it cleans up all of that price action. What you were seeing before was the 4-hour chart. Now what you're looking at here is the 20 pip range bar chart. And notice how much cleaner it looks. Okay? So I'll take you back to the 4-hour just so you can see the difference, and then take you back to the range chart again to see the difference for yourself. Awesome. So another way you could define a range, like I said, is using singular candlesticks. So I'll show you an example. And for those of you who don't believe me that a 15-minute candle, honestly, it's not about believing, it's about definition. I've given you a definition. A single 15-minute candle can act as a range, all right? So remember what I talked about. I think I'm getting ahead of myself here, but I'll show you. Right click, change this to white and make it transparent. This is a 15-minute candlestick. All right, from this high to this point here, it's a range. You can work with that range if you want to, with proper context, okay? With proper context. We'll get to that soon. But now that you know how to create a range, you know that you can use swings and you could use individual bars. You could use the entire day's range. You could use an entire trading sessions range, like London session, New York session, Asian session. It all depends on you, right? Now we must talk about the different kinds of money that you find within your range and outside of your range. So there's two kinds of liquidity. Two kinds of liquidity. Let me drag this and make sure you can see. And I think I'm going to get rid of my period separators just for now. Viewing options, gone. Much better. So there are two kinds of liquidity, okay? Primarily. One, you have external range liquidity. External range liquidity, which is simply money outside the range. And then you have number two, internal range liquidity, money inside the range, right? Of these two, there's two primary types you can look at for each one, right? Number one, you have liquidity at the highs. Number two, at the lows. So for those of you who are familiar with ICT, Inner Circle Trader, who is the person that I credit for this idea? Okay, it's not mine. I just took it and made it my own version of it, like a simplified way to understand it. So I'm giving credit to the guy. It's Michael Huddleston. Some people say he did not come up with it. He took it from someone else. I don't know, can vouch for that, but I just know that I learned from him. So he would talk about stuff like relative equal highs, relative equal lows, and all of that, old high, old low. I don't want to stress ourselves like that. Just highs and lows. Let's simplify, right? Then when it comes to internal range liquidity, there are two kinds I'll be talking about. One, you have order blocks. Hanan Baban, I hope you are here. Number two, you have fair value gaps, right? So we'll talk about these things. Let's first start with external range liquidity. So in this particular situation, it's simply that there is money resting outside of here and outside of here. As how? In the form of stops, stop losses, pending orders, and things of that nature. So let's take a look at this here. This is a 4-hour chart. So what you're looking at here, even if it looks like, oh, it's a swing that immediately turned around, if you go to a lower time frame, okay, because price is fractal, you'll see the proper swing that created and led to this. Now, in this situation, you have a high here and the market pushed significantly away from it. So that makes it a valid high. Then the market creates this low at this point and pushes up. So now what do we have here? Let me grab another rectangle. What we now have here is a range. And what did I say before? I said that the odds are when you have a range, if the market's coming to take out the high, the odds are it wants to turn around and then take out the low or at least stop at 50%. And I'll get to why I'm talking about that 50% thing really soon. Okay? So you can see that literally play out here. This does not happen all the time, which is why I always say this, and you're going to understand it clearer as I get into the concept of ranges. I keep saying that whatever you do, you must figure out what kind of trader you are. So let me grab another text box here and delete all of this. What kind of trader are you? The reason it's important for you to figure out what kind of trader you are is it will help you ignore any setup that does not look like your setup. Okay? So you may be the kind of trader, the first thing I just showed you now is an external to internal liquidity trader. What does that mean? You are the kind of trader that takes money from outside of the range and looks to get off of the bullion van somewhere inside the range. Okay? Inside of the range. Remember, internal liquidity. Liquidity is inside the range. External, it's outside the range. The second kind of trader that you could be, okay? So take notes, guys. I don't think I've talked about it, but I don't think I've typed it before. Second trader you could be is, obviously, you've guessed it, an internal to external liquidity trader. In other words, you are the kind of trader who, once you've defined your range, you go inside the range to look for internal range liquidity, which I will show you shortly, and then look to trade that and take profit outside of the range. So let's talk about what internal range liquidity is. Now that you know liquidity rests at highs and lows, so in this case, I've defined for you a high and a low. There's liquidity resting here. We took that, and then eventually we came to about 50%, dipped a little bit, pulled back, and then pushed back down, okay? So that's going from external to internal. But what kinds of internal liquidity are there? Because if you know that there's money resting at highs and lows, in this case, look here, we had a bit of a low. This was all rangy. You know when we say a chart is ranging, consolidating, it's a sideways moving market. This is a 4-hour chart, remember, so that means there's still something you could take for yourself, sort of. Okay, so this is a low here. Notice how the market takes out this low. Let me grab another rectangle so we can talk about it properly. So we have this high here, and I pull down, and then you have this low. And what happens if I extend this? If you'd gone to a lower time frame to wait for a break in market structure or something, or some sign that the market's ready to buy, that's how you take advantage. So in this case, you would be an external to internal or possibly beyond. That kind of trader, okay? So now let's talk about what exactly is internal liquidity. I hope Baban is here. Oh shit, I deleted all my notes. Well, I have no screenshots. Now go there, right? So there are two kinds of internal liquidity. I have to retype that at the very least so you know what I'm talking about. And those of you who missed that, don't worry. This particular live I will upload to the internet, to my YouTube. You can go look for it there. I changed this to yellow and I changed that to blue. I changed that to 16. That's not yellow though, that's still red. What's happening? All right, boom. So I said, number one, the internal range liquidity that we have order blocks. And then we have number two, fair value gaps. Okay. These are internal range liquidity, or I just like to call it IL liquidity. All right. That's my short form for it. So you have two kinds. Let's talk about order blocks. For an order block, you want to see a low get broken. Okay, look at this low here. 1, 2, 3. This low, it gets broken strongly with a close here. Once that happens, the bullish candle that led to the move that broke this low. Sometimes I'm phrasing it that way for a reason, because sometimes it won't be this immediate candle, it'll be something else a little bit higher. The candle that sponsored the move that broke the low, the most recent low, that is your order block. Is Baban here? I hope he's here. I haven't been checking the comments, but I'll keep calling your name. So let me mark it for you. Right click, change this to white and make it transparent, please. Thank you. Lighter, lighter. Cool. I'm going to zoom in now. I think that's a little too light probably. So all you're doing is, as soon as this low is broken with a close, okay, preferably with a close. If you're on a high time frame, a wick is fine. If you're not on a high time frame, I would prefer you wait for a close. So the close is lower than this low. Once that happens, this last bullish candle before the break becomes your bearish order block. And the idea is that once it breaks and closes, what's happening is you have the big boys, the big girls, the hedge funds and all them, whatever's, I don't know, central banks and co. They cannot just put in their orders all at once, because if they did, then the market would just take a huge fat dump and all of us would sell and would be happy and rich forever. They don't want that. So what happens? They first put in some orders here and the market travels away for a bit. Then they come back in to put the rest of their orders in. So bit by bit, okay? So all you're doing is, once this break happens, you're looking at this and you're telling yourself, I'm going to place a pending order here, which in this case would be a sell limit. You place a sell limit order, the market comes back, when it opens here, it comes back and it triggers. It triggers you into a trade. And then eventually it goes down. Your stop loss ideally should be just above the swing to be safe. All right? That's one way you can play it. Another way you can play it, if you want a tighter stop loss, is you can go down to a lower time frame and refine that. So let's quickly talk about it, and then I'll move on to the second kind of internal range liquidity. So let's see what happens. That was a 4-hour chart. This is now a 1-hour chart that you're looking at here. Remember this low? That's the low that got broken on the 4-hour. So look at this low here. This low on the 1-hour got broken by this bar. When that happened, okay, you could refine it. You could use here, and in this case, it wouldn't have tapped you in. Or, this is a tricky one. I don't like it, but let's just roll with it. Ideally, this red bar, what I just did now is actually very wrong, in my opinion. But because I'm trying to show you the thing coming to kiss it here and drop. Okay, but ideally, this should also be white, because what you're looking for is, if you have consecutive, hold on, let me zoom in actually. I need to see something. I thought we had, okay, no, it's not wrong. It's not wrong. We have this low, this gets broken. The last bullish candle that led to the move. Why is it not wrong? This is the candle that has the highest high as well. This was the reversal point. So that's actually an order block. So notice how it is now much smaller. I'm going to take you back to the 4-hour chart for you to see something. On the 4-hour chart, this was the entire order block here, and it was worth 28 or 27 pips, right? When we dropped down to the 1-hour and looked for that break and looked for the last candle that led to the break, which is here, now you have a stop loss that is just 16 pips, or yeah, 15, 16 pips, pretty much. And that's how you can refine these things if you go to a lower time frame, okay? Now, the second kind of internal range liquidity is called a fair value gap. So before I jump into that, I just realized I want to show you what a bullish order block is, just for the sake of being thorough, because some people will need their hands held. But it's the same idea, which is you have a high, the high gets broken. The last candle that led to the breaking of that high, the last bearish candle, that is your bullish order block. So remember the logic behind this. The big monies, they're not going to put all their orders in at once, because that will send the market skyrocketing and everybody would know immediately, yeah, let's hop on this. So instead, they put some here, they move away, they bring it back, and then put the rest of it here. This is why it's called an order block. This order is here. They come and put in the rest, and then they take off. So you would have, once this break happens, you have this here as your, before your buy limit, you have your stop loss below the swing here for about 7 point something pips, and then you can write that, okay? To be very clear, please do not go trading every single order block without proper context. By context, I mean the trend. The trend. You cannot be looking at a bullish trend and you're trying to enter into a bearish order block unless you're going for a really quick scalp, or that bearish order block you're seeing is on a high time frame, which means that you can get a little something for yourself. Okay, I always emphasize this. If you want to increase your accuracy with these things, you must consider the trend. You must also consider where you are within the range. So I've just talked about order blocks, and I will explain what I mean by where you are within the range in a second. But let's move on to the other kind of internal range liquidity. By the way, you have another situation here. This high got broken. And what is this? This last candle here becomes your order block. By the way, because you have another candle that's also bearish just before it, if you want to, you can extend it and also cover this. So the consecutive candles that are also bearish, that's all your order block right here. Okay? So let's talk about a second kind of liquidity. And in case you're wondering, why is this order block called an internal range liquidity? Think about it. You have this low created, and then you have this high created, then the market retraces. If this entire thing, we've talked about from swing to swing being a way to define your range, right? This order block is inside of the range. So this is the range here, the range in question, from this low to this high up here. Let's zoom in so you can see this clearer. Oh, why do you keep doing that, bro? Come here. So the order block is inside of the range. That's why it's internal range liquidity. Now let's look at the second kind of liquidity, which is the fair value gap. So with a fair value gap, you're also waiting in a bullish situation. You're waiting for a high to get broken. Once that high gets broken, you're waiting to see what the next candle does. The next candle closes. Once it closes, you're looking at the low of this candle, all right? And then you're looking at the high of the previous candle before the one that broke this high here. You're looking between these two places and you're noticing that, wait a minute, there's this space where this wick didn't trade through this body and this wick here didn't trade through this body. So you're going to mark that space, okay? Hang on a second, let me get that correctly. Marking that area, and then this one here. It's a very tiny one, but nevertheless, you will see that it's just as powerful. So once the market leaves this gap here, what is happening with this gap? In this gap, there was nothing but just buying. Buying, buying, buying. And the market has to balance that out with some selling. So what happens? The market opens here and then trades through it. But it does not break it. It just closes. There's just a bit of a wick here rejecting this. And then it takes off from there. So that's another way that you could enter trades with internal liquidity using fair value gaps. And when you have an order block that is followed, because this is an order block, remember, followed by a fair value gap, that fair value gap is telling you this order block is very likely a high probability order block, meaning it is very likely to work out. Okay? Now, for some of you, I keep saying this, some people will use the highs and the lows for their order blocks. They will take the whole thing. And some people will prefer to take, in this situation, the low, but then the top point for them will be this open price here in a bullish situation. And in this particular case, the market actually respected that and took off. But sometimes doing this means the market may not tap you in because it may not come all the way to this open price here. All right? Here's another example. You have this high, it gets broken by this bar. In this particular case, you'll notice the fair value gap is already created as soon as this guy closed here. So you didn't have to wait to see what this candle does because it's already created. So let me mark it out so you can see exactly what I'm talking about. Remember, we're noticing that this area here is just body. This wick did not trade through it, and this wick did not trade through it either. So what do? We drag that back. We've marked this area here where there's no wick passing through from here or here. Okay, this wasn't the candle that broke it, arguably, yes, but it's still a fair value gap. And what happens? The market pulls back into it. Notice how it closes, it wicked through, but it could not close beyond that. And that's a sign that it's probably going to respect this. Heavy on the word probably, because I will never teach you that anything is 100% all the time. That's a recipe for disappointment and disaster. So it rejects this here, and then we're off and running. So that's an example of your fair value gap in a bullish situation. Let's look at a few bearish examples. I'm going to go back up to the 4-hour chart. Let's see what I can find here. If anything, looking for clear examples. Right, here's one here. So look at this low. This low gets broken by this candle. Then this candle does its thing, opens, pulls up again, and then closes down here. In the process, what does it leave behind? Here we have another fair value gap. I'm going to change that color, make it make sense so it's easy for you to see. Maybe a little more, yeah. And then I'm going to zoom in because I need you to see this. Remember, this wick here and this wick here. You notice that there's just body, there's just selling. That has to be balanced, okay? So what happens? You're marking this gap with the idea that the market is likely to retrace into it. And if it does retrace into it, you want to be ready to sell. Sometimes the market will just tap. It will just barely pass this by maybe a pip, and then it takes off running. Other times, it will do stuff like this. It will actually push through it. So in situations like this, the best thing to do is jump to a lower time frame, see if you can get a break in market structure or something to confirm that the market's actually ready to turn around. Your other option would be to wait for a swing. What did I say a swing was? It is the actual turning point in price, the precise turning point. And how to identify that swing? And in this case, you're looking for a swing high. You have a 3-candle pattern. The candle in the middle is the one with the highest high. That's how you know, okay, this is my swing. Okay? So let's go down to a lower time frame and see how we could have made this work out for us. This is a 4-hour chart. I'm going to drop down to the 15-minute chart now and locate that area for us. Do I have the right one? Yeah, this is it here. So this is that 4-hour fair value gap. The market retraces into this. Okay? It's pushing up. One of the things I want you to notice is, remember we talked about swings, about highs and lows being where liquidity is? What do you have over here? Let me grab my arrow so you can see it for yourself. I'll grab my arrow. I'm going to make it bold. Yeah. That's a high. Why do we know it's a high? Because that's where price pushed down from dramatically. What is this? Down here you have a low. It's just more detailed because now we're on a 15-minute chart, okay? But that's a high and that's a low. So what is that? Remember, people, where's the money coming from? Where's the money going to? We have now defined a range to play with, okay? So inside of this range, if you look here, how can you work with this? One way you can work with it is you can simply wait for a break in market structure. So you have this, we want a low to break in this case. You see this, it pushes up. We come back down here, we've created this new low. Let me zoom in so it's clearer. We've created this new low here. the swing low, and then this candle breaks it. When this candle breaks it, remember what we said, this bar automatically becomes an order block. So notice how we have taken something that would have been like too many pips. Your stop loss would have been about 40, 50 pips. And then we've come to a lower time frame to refine that. And now with this break here, we have a brand new order block we can work with. Your stop loss would only have to be about maybe 8 pips, or if you want to be safer, put it above here for about 13 pips. Okay? If you can set your pending order here, and in this case, what happened? Notice the market pulled back into this order block at this point here, tapped you in, and you're off and running. That's one way you could have done it. Another thing is, when this low broke and then this other candle closed, you have a fair value gap. Okay? And notice, I'm pulling out now so you can see, when this happened, the market never returned to that high, and it went down for so many pips. Okay? Alternatively, there is something that I need to talk to you about when it comes to ranges. It's the premium discount array. I'm going to change this to 16, and I'm going to change that to bold so we can see clearly what I'm going to type now. When it comes to a range, there are 3 portions of a range. I'm going to change that color to something brighter so y'all can see it clearly. 3 portions of a range. We have equilibrium, god damn it, premium, and discount. So what do these things mean? Well, let's talk about it. For that, I'm going to take us back to the 4-hour chart just because it's clearer for me to show you this example. So remember, this is the range that we have identified on the 15-minute chart here. What I'm going to do is select the high, this high here. And yes, you could argue that I could have stretched it all the way to this wick here, but I'm not doing that because what is this? We had a push up, push back down, and then a pull up again and back down, pull back rather, and then down. So I'm focusing on this as the turning point. Remember, that's a swing, the turning point in price. And then I'm using this low here, another turning point. So I have now defined a range. The halfway point of a range is called the equilibrium. Equilibrium is a word that means balance. Balance because you have a balance of buying and selling action there. Buyers and sellers, if you will, if you want to use that story, they are in agreement on what the price of the asset should be within that portion of the range, the 50%. You don't want to deal with that unless you're using it as an exit to take your profits. That is my opinion. Now, you have from the 50% portion, the area above it, that is your premium portion of the range. When you are in a bearish trend, you want to sell the premium portion of a range. It is important to highlight when you are in a bearish trend, okay? If you attempt to sell the premium portion of a range in an uptrend, then you must make sure that that range is based on a high time frame or a high range frame, because that means you'll have something, some pips to take for yourself. And you must also realize that ultimately every other time frame takes their orders from the higher ones. Range frames is the same thing too. They take their orders from the higher ones. So you have to be really quick about taking your profits if you decide to sell in a bullish trend based on a high time frame retracement. Okay? Now, the area from 50% to the downside is called a discount. You want to buy the discount portion of a range when you are in a bullish trend. The only time you should be buying the discount portion of a range in a bearish trend is if you have identified that retracement to the upside on a high time frame or a high range frame. Otherwise, it's much better for you to just buy when you're in a bullish trend. If you insist on doing the opposite, be very quick about taking your profits. Okay? So with this said, I'm going to take you guys back down to the 15-minute chart. Give me a second while I slide this here because TikTok needs to know I'm available. And I think if you tap some activity or something, they'll think that I am here or whatever. I don't know. I heard that. I don't know if that's true though. There we go. So now let's go back to that 15-minute area once more, which is over here. Remember, we talked about waiting for this to get broken and all of that. But what if you could have told way before this break that you should actually be selling already? Well, all you'd have to do is look left. We've defined the range. If you look to the left, you're looking for something in the premium portion of the range. What do we say the premium portion is? Anything above 50%. So you're looking to the left. This price is trading up here. You're looking to the left, and what do you see? This is an order block. Why? You have this low. Let me bring it into focus. You have this low here. It gets broken. Boom. This is the last bullish candles, the two of them. You could mark that out. So what I'm going to do is I'll set a line for you to see it for yourself. And everything I'm showing here, don't just accept it and then go and start trading live. Please, please, please go and test for yourself. Look it up for yourself. I need you to see it play out for yourself. So here's that yellow line there. And now let's go and let's see what happened. Notice how the market tapped into it beautifully. And there was not really much drawdown, just like what? 3 pips almost, not even up to 3. And then it shifts itself. Okay? So, having shown you this, let me go for another example. I'm going to go to a range bar chart for this one. Wait for it to populate. It needs time. So, let me delete all of this so there's no confusion. And this guy can go too. Great. You are looking at a range bar chart right now. Each of these bars is worth 50 pips. Think about what I said. You have a low here, which is the point the market was pushing down, and then it came here and then it turned around and has made this high. If you wanted to, you can mark the whole of this as your range, which would mean, let me show you, which would mean what you have here. In this portion, this is your discount portion of the range. If you zoom back a little, you will notice the market has been trading in a range. If I add all of this as well, it's not pretty, but it is a range. It comes here, it goes here, it comes here, it goes here, it's come here. That already tells you, okay, we are within quite the range. So we could extend that if we wanted to. But the point of it is this. In this situation where you have an actual ranging market, it's okay for you to start looking to buy the discount or to sell the premium once the market has demonstrated to you, as it has here, that it's having trouble pushing past 2 certain price points, okay? All you have is this little wick here and this little wick here. So it's just going discount, premium, discount, premium, discount. In this case, the range has not been broken yet. So if it's coming in here, you could be looking to buy. So you could look at this and go to a normal chart, or even just use this one and look at this as an order block. I've not taught you that before. Those of you who have CTrader, you can look at it for yourself once you've defined your range. And it's even cleaner. So the market trades into it, and then it starts to reverse. Why am I telling you this? Because I want to draw your attention to a different way of looking even more granularly at the charts. Simplifying your life. Again, I said this is a range bar chart. It's available on CTrader, which is for free. It's a free trading platform. You don't need to pay for anything. So this is a range bar. It's a 50 pip range bar, and I'm marking the high and the low. Why am I doing this? It's not random. It is in the discount portion of a larger range. And remember I said you can define a range either using swings, as in highs and lows, or you could use single bars. Whether it's a Japanese candlestick, whether it's a Renko bar, I don't care. There's 2 different price points, which means it's a range. So Remember, I talked about how you can either be an external to internal liquidity trader, as in the kind of trader who takes money from outside the range and then trades it all the way into the range or to the other side. Well, now I'm about to show you how you can do the opposite. You can be an internal to external liquidity trader, meaning your job is to get the money from inside the range and take it outside the range. In other words, you're entering inside the range and you're exiting outside the range. So now that I've marked this for you, what are the ways you could work with it? Way number one, to keep your life simple. What did I say? If you have a range, you're looking to buy the discount portion. So you could very simply have an alert at 50% or a pending order at just below 50%. Okay? An alert just below 50% or a pending order just below 50%. It triggers, you're off and running, your stop loss would be at the previous low. But if you want something more precise, what you can do is this. Let me lock this in, and then I'll take you to a lower time frame. I'll take you to, let's start from the 15-minute chart and see what we can get. So this is the 15-minute chart here, and this is the very point at which that 50 pip bar closed. Let's measure from here to here. That's that 50 pips right there. Once it happens, I don't know why you guys keep inviting to co-host, guys. Please, you're distracting me. Once it happens, you only have business with this portion of the square. In other words, you're looking just within here, and not even all of it. You're looking at the bottom left. Why? Because remember, you want to buy in a discount. So what are you seeing here? Well, let's see. 50%, below 50%. Okay, we have this order block type looking thing. Okay, well, there's that. But what else can we find even lower still? Well, we can see that there's this fair value gap. And if you don't like what you're seeing here, you want more clarity, it's simple. We'll go to a higher time frame. So that was a 15-minute chart. This is a 30-minute chart. Now you can see even clearer this high that got broken and left behind this fair value gap here. So what happens? When the market starts to retrace, you can have a pending order here with your stop loss below the low, or you can simply wait to see what happens next. In this case, the market trades into this fair value gap. And then what happens? It's a 30-minute chart, mind you. What do you have here? This is a high. It gets broken. When this high gets broken, what is this? The last bearish candle that led to this move that broke the high. Great. So you mark that out. What happened later? The market retraces into this candle, respects it, because that's your bullish order block, respects it and takes off from there. That's on a 30-minute chart. Let's see how this played out on a 5-minute chart. There's no hard and fast rules about how you can trade with this. It's up to you. If you don't want to look to the left and start playing guess which part it's going to react to, another thing you can simply do is, okay, we've created this 50 pip range bar. Remember, this is where it closes the top of this rectangle. Okay, we're just going to keep waiting until something breaks to the upside, preferably when the price has gotten to the discount portion. And then it does that. You have this here. It's a mess, but it does count for something. This candle breaks that. Once it breaks it, let me zoom in so you can see better. And I'm going to delete this because I need you to be able to see. This candle breaks it. Then this other candle closes. What do you have here? It's tricky, but you can see there is a fair value gap. Now, this is very tricky. This was market close, so you should have no business being here. The spreads would be ridiculously wide. But let's say it was a regular trading day. This is your fair value gap. I know this one looks tricky. I know it looks tricky, but it is. And look at the way the market taps into it and takes off from there. If you don't like it because it looks weird, no problem. Let's see how else you could have gotten in. Those of you who like to use trendline breaks, this is why I keep saying I'm not looking to change your strategy. I'm just looking to tell you the story of price so you can work that into your trading so you can have more precise entries. Sorry, let me change this. I'm not a trendline trader, by the way. I don't know if you guys use DeMark or whatever kind of trendline trading you do. But this is a general example. So let's say I've taken these two highs here, 1 and 2, and then this guy is broken. Okay, well, boom, there you go. Those of you who like to use support and resistance, let's see. Let's grab this line here and whatever. Let's see, I'm looking at these two highs here, and then this guy's broken. Okay, great. And then now that you're using support and resistance and you're noticing that this was a low and then the market starts to pull back from this high and then this high again, you can say to yourself, remember, swing, swing, or high and a low. Okay, that's a range. Where's the discount portion of the range? Is somewhere in here. Okay, then let me just look to take my entry somewhere here. When I find a swing, what is this? A swing is a turning point in price. I keep saying swings become significant when you pair them with the concept of liquidity. And this particular swing here is rejecting what? Another fair value gap. It's there. Here. It wasn't fully filled when the market came back here. There was still some gap left. And then you still have this as well. So you start thinking, okay, I have a swing here. Okay, great. I can get in and let me have my stop here and see how it goes. Or I want to be safer. I'll get in here, but I'll have my stop at the low here. So you see how it doesn't matter what you trade with. At that point, it's that you're now using a very highly likely area, an area that's likely to give you some sort of reaction that you're looking for. So once you know the concept of liquidity, order blocks, fair value gaps, all you're doing is just locating them from the higher time frame or the higher range frame, and then you're looking for the relevant areas to take your trades from, however you usually take your trades. At this point, that's why I keep saying I don't have to change your strategy. I'm not trying to change your strategy. I'm trying to get you to consider the story of price. There is a story your chart tells you every day. And the story is liquidity. It's money. Okay? So I'm showing you how to find high probability setups. So let me take you back to the 50 pip range bar chart. One moment, it needs time to repopulate. So here we are. This is that here. Your entry would have been, remember this trend line? Well, somewhere around here. And then how do you know where to get out? One of the ways you can get out is, since this is a range bar, and I've described to you that a range bar will not create a brand new bar unless, in a bullish context, unless the market has pushed 50 pips from the low. Why 50 pips? Because I set this chart to 50 pips, not because that's a rule. So if you're using a 20 pip range bar chart, it would be 20 pips. So how can you calculate your take profit? It's simple. If you're not taking profit at the close of the previous bar, which you use to frame your trade, remember, let me grab this rectangle again and draw it one more time. Right clicking, changing that to, and transparent. Remember, we use this to frame the trade. Okay, and then the market trades into here. You've noticed the low has been created. This candle, when the low is created and when you have your break in market structure, you start measuring from the low and you measure from that point to 50 pips upward. And that's where you could put your take profit as well, if you want to. Or if you want to be safe because you're worried that the market may turn around against you, just take your profits here. Or if you want to be safer still, you could just say, all right, it's 50 pips. I'm going to take half of that, or I'm going to take just 30 and call it a day. Okay? So I think that's pretty much it. I'm going to show one more example, a bearish example. What is this USD CAD? Let's see what happened on this guy. Someone in the comments was saying, look at GU. Let's see if using a range bar chart. Guys, once more, it's a range bar chart. You can find it for free with this platform, which is called C Trader, letter C, and then Trader, all in one word. And you can get it for free from spotware.com. Or if you have a broker that supports it, download it, try it out. I think you'll like it. So let me show you the same thing here. Right-clicking, changing the color, and making it transparent for you. I will admit I haven't looked at anything to the left. I'm just looking at this because it played out. But if I were to, what do we have here? We have multiple swings. So let's see. We had this and then this, this and this. All right. Pushing down to here. So I could very well say this right here. If you look very carefully, this is a swing high. If you look carefully, this is a swing low. If you look carefully, this is a swing high. So if I wanted to, I could say, I'm noticing that this is a range. This high here that pushed all the way down into this low here. So what did we say? You're looking to be a seller when you are in the premium portion of a range. in a downtrend. And what do we have? The market has generously been pushing down for 300 and something pips. Okay. Sure, it's pushed up a little bit, but in the context of this range that we have defined, it's in the premium portion. Then you see that you have this bar. This wick is a very, very nice indicator that maybe, just maybe, the market wants to turn around. So what can we do with this information? In this case, I'm not sure the market actually made it to 50%. Let's zoom in. Let's find out. So here, 25 pips. Probably we'll never know. Sometimes it'll happen where you don't get that retracement into the 50. It just means you'll be left behind, but it's not deep because you'll find another setup. But let's see how it would have played out anyway. If we go to a 15-minute chart, let's see how it would have played out, because sometimes you'll see obvious setups. So this is a 15-minute chart. And remember, this is that bearish 50 pip range bar. And this was the area where it closed right here. So then you're looking at the halfway point, or just beyond it. Beyond it in this case would be like around here. The market didn't pull up into that though. Now, but it did have this here. It's risky. Remember what I said about 50%, that you want to actually be above it. But in this case, if you are feeling pretty confident and comfortable, whatever, just make sure your risk is not too much in case the trade doesn't work out, because we are still in the discount portion of this range. Okay? However, there could be a different way to frame it. Something I have not talked about before, I've only touched on it very briefly, is the idea that the market, the price is fractal. I've said that before, but let me get more granular about it. I'm trying to say that there are ranges within ranges. There are swings within swings. I need you to note those two sentences. Those of you who actually love to study your charts, you don't just come and listen to me. You actually go back and you apply what I teach. You're going to love this one. Think about the idea that there are ranges within ranges. There are swings within swings. And think about what that means for how precise you can get with your trading. I won't say any more than that, but I will show you one example of what I mean. So right now, you're looking at this 50 pip range, and what you're supposed to do is you're supposed to sell at a premium, right? In this case, you didn't get that opportunity. But then you may have noticed something, that this is a high here. 1, 2, 3, swing high. And then the market pushes down. Granted, it pulls back up, but it pushes even lower down. Okay, great. So you could say to yourself, here's my range high, range low. Now what do you have? A range within a range. Let me show you. Hang on a second. Let me change the color to something less dramatic. You now have a range within a range, from here to here. And now you can ask yourself, okay, in this portion of the range, what is in the premium portion? Look left, fair value gap, order block. What did we say about fair value gaps paired to order blocks? Order block is high probability. All right, sell limit order here. What happens? The market taps into it beautifully and rejects it so dramatically. In the same way, okay then, how might you calculate where to get out? You already know that this white box here is actually the close of that 50 pip range bar chart. So if you wanted to be safe, you could close there. But since you know also it's a 50 pip range bar chart, and on top of that, you remember that, hold on, let me show you again in case you've forgotten. You remember that we have this larger range here. What did we say? I'm going to take another rectangle and put it back because I don't want you to get confused. Remember, we have this larger range here. Ranges within ranges within ranges. So if you're entering somewhere up there, you found your entry, this is an entire range. What would you be targeting? At least 50% of the range, or you'd be exiting as soon as you're entering into discount. If you're feeling very ballsy and you have a lot of patience, you could wait and see if the market wants to give you all of this. But if you're going to do that, bear in mind this is a 50 pip range bar chart. That means you're holding for 200 plus pips, which means try to take some things off the table. Don't be greedy. Don't get into a position and you hold that shit and you're like, yeah, I'm going to see how far it goes, and then you don't take anything and then the market turns against you. Okay? You don't have to close your entire position. When it goes quite profitably or quite handsomely in your position, you could close some and then let the rest play out and see how it goes. So remember what I just shared with you. Ranges within ranges, swings within swings. This is a range. This is a range. Within this range, I took you down to, what chart was that? The 15-minute, yeah, this guy here. And we created yet another range inside. Let me drag this so you can see. Are you starting to get the idea? Even if you were to take an individual bar here from this swing formation 1, 2, 3, what's the most? This is the high of that swing, and this is the low of that swing. Again, another range. That's how you get even tighter stop losses if you want them. Range high, range low. Let me show you so you're not confused. I need to get this off the chart because it's not letting me. So look at this swing. Let me come closer. Wait a minute. 1, 2, 3. This is the candle with the highest high. So that's the high right there. And the low of this swing, 1, 2, 3. This is the low, same bar. Okay, cool. This is a 15-minute chart, GBP USD. We have now defined a range. What do you notice? This is 50% of the range. What did the market do? Traded through it. You have a fair value gap here. The break in market structure was not that clear, but because you have framed this on higher ranges, higher range frames, higher time frames, this becomes a significant fair value gap. Let me take you lower still to the 5-minute chart. Let's go take a look at what happened here. This is your 5-minute chart. What do you have? This is that single 15-minute swing. The high of the swing and the low of the swing. Ranges within ranges, swings within swings. Price is fractal. What do you have here? This is a 50% point. This is what? A fair value gap. In this case, did the market tap the order block? No, it did not. But that's still fine, even if you missed that. Okay? Even if you missed that, whatever, you could have just focused on the fair value gap as well. So the thing is, you don't know what's going to happen here. When the market's doing this, you have no idea what's going to happen. I'm not trying to paint that picture in your head that you know exactly what's going to happen. You don't. What you're doing is you're waiting for the market to show you its hand. So if you were waiting for this order block to get hit, but instead what happens, the market pushes up here and then you get this bearish engulfing bar. All those candlestick patterns, let me tell you right now, they don't mean shit. They only matter in the context of liquidity, in the context of a high time frame. Outside of these things, forget about it. If it's not a high time frame, a high range frame, or you're not working with liquidity, this is why you wonder why you see these famous chart patterns and they don't work out. This is why I say also, you don't buy every bullish swing. You don't sell every bearish swing. You need context. What is the context? What do I mean by context? Number one, what is the trend? Have you identified the trend? Number two, have you asked yourself the 3 questions that we always ask as traders, which is, where's the money coming from? Where's the money going to? Is there enough room between those 2 places for me to enter a trade and take some for myself? All right? So at this point, you really don't know. But then you see this. There's nothing wrong with you entering here and having your stop loss at that high or having your stop loss above this swing high here. Nothing wrong with that. All right? Even then, let's see how you could have made this more granular. For those of you who care, you don't need to. I don't think you do. And I personally prefer to use wide stop losses every time I use something too tight. That's just me personally, because I'm not in the mood anymore for that. I get my ass handed to me, right? What do we have here? We have all of this. I generally, and this is my personal preference, I don't like to see this shit as a break. It's too much. I know a way, and I'm looking at it right now for me, but I'm not going to point it out, for me to actually enter through here, but I don't use that. I'm very precise about using just 2 things. I don't want to confuse myself unnecessarily. So what could I have done? When the market is retracing up into here, this is that fair value gap from the 5-minute. Now what? Look at this low. Look at this low. It gets broken. Then this bar closes. What do you now have? A fair value gap. What did I say? Sometimes the market will just kiss it barely. Just a tiny little wick and then take off. You could have entered there. Your stop would be here for about 9 pips. Or if you had used just the engulfing, this is where engulfing bars can become powerful. Notice how, because you're using liquidity, notice this bar. Let me zoom in so you can see. This bar got engulfed by this bar. For me, an engulfing is not, I need to see the high and the low. I need to see everything completely within this candle's body. Okay, not that there's a little bit peeking out. I need everything inside, or I don't call it an engulfing, but that's just me. Okay? Notice you have another one here. This is when all those patterns now start to make sense and behave the way you want them to. Notice you have this here automatically. That is what? It's giving you where to enter and where to place your stop loss. And if you're thinking about price critically, all right, because trading is also about thinking critically, you'll realize something, which is that when you have those engulfing bars in a sense on a lower time frame, because there are time frames lower than the 1 minute, okay? You have seconds, you have tick charts even. What the engulfing bar is essentially doing is creating an order block. Now, just as with any other order block, it's not every time the market will retrace into the order block. Sometimes it won't touch it until later. Sometimes it will not touch it at all. Sometimes it'll blow past it. That's why I've always said not everything works 100% of the time. Okay? I think that's about it. I think that's all I have to share. It is 12:27 my time. And a girl's tired. So what I'm going to do... I don't know who this is or what that's about, but Boss Pablo, thank you for the follow. Siashoto, right now it is 12:27 a.m. OG Eskimo, you're very welcome. I'm scrolling back up. This person who's called a period, talking don't bark, and what the fuck don't lie, it's nothing. I hope you're not insulting my people. Don't lie, you are a retail trader. Who is he talking to? Disrespect is not tolerated on here. Disrespect is not tolerated. If you're not offering value to people or trading, you better shut it. You drop another one, you're getting blocked. I actually admire the fact that you apply 50 pip ranges in currencies. It means that you weren't crazy at all this time. No. This was not gold. I was looking at GBP USD. I don't trade gold. Gold Netflix FX, thank you for the follow. Obi was the one. Oh, that entry was fire. Philosophical Gemini. By the way, I love your username. Prince Alpong, thank you for the follow. What strategy do you trade with? I trade with a story. I don't know what to tell you again at this point. I just explained everything. Lee Y, Uncle Louisbo, thank you for the follow. Emma, thanks for sharing the live. Sloggy the Don, thank you for the follow. Ilerica, thank you for the follow. Sumuki, thank you for the follow. Booze Bear, thanks for the follow. Some like to call this the AMD setup. Yeah, I get you. But my thing is, I'm trying to keep it simple. As stupidly simple as possible. I want discount and sell side simple. Time are you asking for? FVGs and OB are easy. Inflow of contracts at specified time is tricky and how. Yeah, so I found, okay, philosophical Gemini, here's my thing. It took me 10 years and I lost for 9 years consecutive, like 9 years of just steady losing. But I always told myself, I said, when I figure this out, I'm going to share it, because one of the things I hated was the unnecessary complexity. I'm not trying to say like those things are not valid. I am trying to say that when you have too many concepts in your head, unless like it's a rare person who's able to hold all of that and not get carried away and not get distracted and not look at a chart and be like, okay, I can see this, but I can also see this and I can see that. Okay, so now what do I do? Oh shit, I'm confused. So for me, I just said, you know what? We're going to focus on ranges, price ranges. Emma, thank you for the follow. Cute Darky, I am Jolly. Thank you for the follow. I think I'm just look at the. Why don't I trade gold? Because I'm lazy. I'm sorry. If you're looking for a fancy answer, it's simply I'm lazy. This is my thing. I don't trade gold for the same reason that while I trade the S&P 500, I don't trade it all the time. Because I like to calculate in pips. Okay, I came to this learning Forex. Forex is my jam. So for me, it's like, I just want to work it out in pips. And so when it also comes to gold on my platform, because I have settings for my risk, I have to keep adjusting those settings. And I don't like that. If I adjust the settings and then I try to trade something else, I may forget that, oh shit, I cannot be putting 2,000 pips or points or whatever it is for gold. I can't be using the same thing for this particular pair. So I just fire off a trade and I'm like, oh, fuck. So for me, I'm just like, nah, I'm not doing gold. It's not like it's that deep. Price is price. And for gold traders, I will say it is very important that you use the high time frames. If you are not at least looking at H4, I don't know what you're doing. Please look at H4. What pairs can you suggest for beginners to start trading on? Some people will say that's a simple question, but I find it nuanced. If you are an easy-going person who you don't need too much control, and you're okay with the idea of wide stop losses, and you like a pair that is wild, the GBP XXX pairs are good because they have crazy volatility. But you must bear in mind, like, you should be willing to have a wide stop because, again, crazy volatility. But if you are the kind of person who you want slow, you want something smooth, you want something that's easygoing, stick with Euro USD. You can also do Aussie dollar. But ultimately, the truth is price is price. It doesn't matter what asset it is. So you are the one who has to do the homework of studying the pairs and finding out what flows with you, what works for you. Okay? So you study the pairs and you see what works best. In addition to trying to figure out, doesn't give a lot, not compared to other pairs like EU or even GBP, etc. Okay? Do you think those traders who claim to be millionaires trading, they're lying? No, because this is a thing, yes and no. So you have marketers, you have people who they don't actually know how to trade, or they're very good at making you think they know how to trade. But what they're really doing, if you go through their content, is showing you Lambos and this and that. They focus on the lifestyle because they understand that the flashiness of the lifestyle is what draws people. That's why when I came into this space, I was very particular that I am not looking to interest or impress the sort of person who thinks that that's where it's at. I said from the jump, I'm not interested in impressing anyone. It's important that you keep your focus on what matters. You can't be thinking about Lambos when you have basic bills to pay. Let's start from somewhere realistic. Now, why I said also some traders are actually millionaires from trading is because I used to be in this group called Knowledge is Free. Then it became Dash for Cash. I don't remember what it's called now, but it was created by the Singaporean guy, Devesh Singh. And I watched him, I remember this was many years ago, I watched him take like was it a 1K account and flip it into about 50? And do that repeatedly. I may be wrong on the figures, but I've seen it enough times. That's part of why I didn't give up. That guy inspired me when I saw it live. And he's not a faker. He's very much about philanthropy. His thing is about, he trades, yeah, but he loves to give back to the community. And back then, for you to have been part of a group, he would insist that you make donations and you show proof that you made donations to the homeless or people in need or children. Tazome, Mama, I need to get some rest for the day. OJ Eskimo, thank you, Jerry. I was demo trading and gaining all day. Now I'm losing a real account. Okay, so Tazome, what you need to do is drop your risk. Drop it dramatically, drop it stupidly to a point where the losses don't affect you. And the reason you need to drop your risk that much is because when you win, even the win should not impress you. You're trading with very reduced risk, not to make money at this point, but to demonstrate to yourself that you can be consistent, that you can actually get results. What you're doing is building the confidence, but it's hard for you to build confidence if you have blown the account before you've traded enough to show yourself that actually you can make money. If that makes sense. So drop your risk. Baban, what is your specific challenge with marriage and trading? Bullets, thank you so much for the follow. I appreciate you. Much love to you. I'd really love to visit Kenya one day. Let's see. All right, there's new comments. Baban, what is your specific issue with... Holy shit. DM me with your challenge, because that question you're asking is a little too personal. I'm not interested in that. I already have some crazy people who are being weird in my DMs. I don't need that shit. I think I have to work more, not trying to put in emotions. I think that you should not be suppressing your emotions. What you should be doing is sitting and feeling them. What you need is not to not put in emotions as much as it is for you to feel your emotions and recognize that you can feel them and not act on them. Because as humans, even me that I'm speaking right now, there are times when we identify too strongly with how we feel. And because we identify too strongly with how we feel, we start to act it out, not understanding that it's okay, you can feel something, but you can choose to respond differently. I'll give you an example. So maybe someone you love has just pissed you off. And your typical response would be maybe to yell or to get moody and sulky. So just try this as an exercise. The next time you feel triggered or you're angry about something, whatever it is you would typically do, that's a great chance for you could just sing a silly song or you could dance. The person that's upsetting you, if it's a loved one, if it's a partner or something, you could try pulling them close as if you're trying to give them a hug and look in the face and smile and do the opposite of whatever it is you would do. What you're doing is you're showing yourself that just because you feel a certain way does not mean that you must act in the way that you've naturally been wired to. But it takes practice. It takes practice, right? Resume, that's basically signal adjacent shit you're asking for, and it will never happen. Much love. It will never happen. Those people who've been following me for a while, they know. I've said from the jump, you're looking for signals, I'll never show you. The highest thing I'll do in the Telegram group is sometimes I'll be like, so there's this fair value gap on this high time frame. Watch that. Let's see how it acts. And that's about it. I'm very deliberate about that because I want everybody to be responsible for their own trading. I want you to be responsible when you win because that shit is nice. It builds your confidence. You did that by yourself. I also want you to feel responsible for your losses because that way you can't like pawn the responsibility off to someone else. And losing is a great time to grow. So I don't do that, sorry. Those situations that most people already do know too much to narrow down their choices. Yeah, exactly. That's why I try to not complicate things, not bring any other. There's so much stuff we could talk about, but I try to keep it just, look, liquidity, highs, lows, FVGs, OBs, pick it. In fact, some people, let me tell you, those of you who are still struggling, you know another thing you could do to help yourself? And you don't have to take my advice for it, okay? But did you know you could decide that you only like to sell automatically? If you just pick one side of the market, and I'm not trying to say that you should go around forcing every trade setup to be a sell because you're going to lose. But you can simplify your life by saying, I have noticed today on the charts that the specific pairs I like to trade, and I'm hoping that you've picked just a few. You don't have to be in everything. I'm noticing today on the charts that I don't see a sell set up, so I won't touch it. Or if you prefer to buy, because automatically you've eliminated like half of your losses. You could say to yourself, all right, now I know about FVGs and OBs. I've decided that I want to be an internal to external liquidity range trader. So I've decided between FVGs and OBs, I prefer FVGs. So I'm going to look for FVGs only. So if I don't see one, I'm not going to touch it. Not even for entry. Like until I get an FVG, I won't touch it. Or you could say until I get an OB, I won't touch it. You don't have to be in everything. You don't have to do everything. Just one thing is more than enough. More than enough. I'm just glad that I did come here on your live as a new person to Forex trading to hear that. To hear give so much attention to a thing. Yeah. Pick just one thing. Highest 2. Ideally, just one. Because another thing that I want to stress is those of you who are struggling, maybe you're actually making money, but you keep giving it back. Did you know you don't have to trade every day? So last week, what happened to me was I made quite a significant amount of money. I should have actually wrapped up. I should have wrapped it up. I didn't. And so I gave some of that back. I'm human too. I make mistakes too. I'm not perfect. But that's my point. So it's key. If you have a target for the day or the week and you've hit it, let it go. And sometimes you'll surpass that target. Now really actually sit down and let it go because you need that feeling of, oh, I'm a winner. You need it to leave your head. So for that, you need to cool down. You may need a few days. Leave it and try to be practical. This amount that you just made in real life, could you have made it from a job? Which employer in this economy could have made that, could have given you that as salary in one day? We must be reasonable. Don't get carried away by the Lambos and stuff like that. I promise you. Do I have a Lambo? No. Matter of fact, I don't have a car and I don't want a car. That's a choice. I don't care how much money I have. I don't like the idea of driving. I wear glasses, or I should be wearing glasses, but I don't care for glasses. So I know I should not be on the road. I also know that sometimes it's just for the safety of everyone else. When I see rubbish, I can't keep quiet and just pretend it's not there. And if you know anything about driving in Lagos, you know. So I'd rather not. But am I eating? Yeah. Am I comfortable? Yeah. Am I taking care of bills that I have to pay? Yeah. Am I clearing my debt? In the process. Let's be reasonable, guys. Don't get carried away by all these things. If that's what you're here to trade for, the markets are going to humble you at some point. I'm not saying you can't have the Lambos and the Range Rovers and stuff. They will come, they can come. But I need you to focus on gaining the skill. And that means forgetting all that shit. You need to master yourself. If you are, I don't want to tell you outright what to do, but if you are following people on Instagram or wherever else, just because you want to look at the lifestyle, I beg you. I used to be there. I used to be that person. There was this guy, I don't know if he's still in business. Back then, it was about 10 years? Yeah, it was still that 10-year period. FX Lifestyle. That's what he used to call himself on YouTube. And then I remember talking to that guy I told you who actually flipped his account, and I told him, yeah, I think it's actually possible to make that money and blah, blah, blah. And he's like, it's not impossible. But he was laughing at me, and I kept wondering, why are you laughing at me? Like, I'm not joking. I'm serious. I want to live that life. And he kept saying, that dude is a fraudster. And sure enough, come to find out years later that everything he was buying, it was all rented. Come to find out he was using that, that prop money that's actually used for movies, not the real dollars, the whole time. So if that is what is impressing you, please, it's time to disillusion yourself, even if the person is for real, even if they are actually buying those things and they're actually flashing proper stacks of cash. Don't let that distract you. Think about it. Put yourself in that person's shoes and ask yourself, why would I be doing this? It's to draw in people. And they get a lot of people, especially newbies who don't have any idea that while trading is simple, it is not easy. It is simple to click buttons, buy, sell, buy, sell. It's simple to analyze a chart. But the actual work in mastering yourself, in knowing when to quit, when to walk away, when to add to a position, when to cool off, those things, they can only ever come with time and experience. No guru can give it to you. No mentor can give it to you. It can only come with time and experience, and embrace it now with losses. Don't think of your losses as a bad thing. It is the cost of getting into this. It is like paying your school fees. You're paying your dues. It is only a loss when you decide, okay, you're going to quit. And if you want to quit, sure, no problem, because I don't want you to fall victim to the sunk cost fallacy either, where it's like, oh, you spent thousands of dollars on trying to master this craft, and therefore, if you quit now, then you've lost everything. No, it's okay. If you really, really, truly, you've done some soul searching and you realize, this thing is not for me, walk away. It's okay. There is no shame in that. Walk away and go find something that is yours. But if you know that you want to be here, I'm telling you right now, disillusion yourself. Forget about all those things. I would advise you, unfollow that shit. Instead, you should be in groups. It doesn't even have to be mine. You don't have to come listen to me. If you don't resonate, you don't resonate. That's fine. I don't need. I'm just here because I love to teach. So even if it's just one person here, I'm happy. I appreciate all of you who are here. Don't get me wrong. But if it was only one person too, I would appreciate that person. My point is, get into groups where they're actually serious about trading, where it's not about, oh, the Lambo, the this, the that. It's actually about the skill. It's about people getting together and saying, hey, so I'm working through this emotional problem where I'm not able to handle my losses, or I find that I start revenge trading, stuff like that. That's what you want. That's where you want to be. That's where you want to be. You master that. You master yourself. It's a matter of time before you have the Lambos if you want. I don't really care about that. I'm not a materialistic person. If you check my videos, you notice that I seem to keep repeating the same clothes because that's really who I am. Like, I don't care. I don't care. So anyway, I hope that helped someone somewhere and you didn't get carried away. Please, can I ask for some help in order to have a right SL before entering? Come to the live. Come to the live Monday. We've already covered that. Thank you for the follows, the fresh follows. Thank you for the shares, Baban. Tell me, how much money do I have? About 1 naira. Would you like some? Send me your account number. The hardest part of trading is discipline. Trading messes up your brain's dopamine reward system. Preach, Wolfen. Wolfen knows. This is gambling, to be honest. That is certainly one perspective. I don't agree with you. It's gambling when you are not willing to put in the work of mastering yourself, which is what tomorrow's live is going to be about. It's gambling when you treat it like gambling. Otherwise, it is just business. I want to give an analogy, but I'll save it for a different day. I have a question. Time, it is important in trading. Yeah, because of multiple reasons, but the most basic reason being that if you're trading during Asia, certain pairs do not have as much volatility, which is fine if that's what you're going for. If you're wanting to trade a low volatility period, Asia could be really good for you. But just be sure that the spreads have returned to normal. If you want volatility, trading the London and New York overlap, very good. Thank you for the follows. FN Banks, thank you. I do one stuff every day in a particular time interval. Beautiful. Yeah, you guys should join the group. The link is in my Telegram. If it doesn't open from here, copy the link and then put it in your browser. It should take you there because Freddie's on fire. Freddie, play. I'll hand over to you now. Since in a joke. Lebogang Madiba, thank you for the follow. On Monday, what time is my live? So my lives are typically by 11 p.m. UTC plus 1. That's Nigerian time. So no daylight savings. It's always 11 p.m. For me, you can do the conversion wherever you are. All right, Ariel, I will be looking forward to seeing you. Arya, you are very kind. Thank you for that comment. Moyo, the live is by 11 p.m. and we're not looking at charts. So if it's charts you want, you have to wait till Monday. But the live is going to be about psychology, which has a touch of spirituality, people. So those of you who will have a problem with that, just leave it. What did you see about trading synthetic indices? So the other night we actually looked at synthetics. We looked at was it the Boom 500? Yeah. Price is price. Doesn't matter what asset it is. Price is price. Price does what price does. It'll always do what it does. It can't not do what it does. Ariel, you're in Togo. That's impressive. That's wild. I haven't been there in a while. I owe Togo a visit. Like, not since I was a child, bro. Do I come live daily? Mondays through Fridays. If the time changes, I'll let you know. It'll be somewhere in my profile. I'll pin the video. Okay, so it seems that's about it for questions. Thank you guys for the follows. Thank you for being here. Thank you for your presence. Thank you for listening to me. Thank you for investing the time in yourself. And now I have to beg you, please do not take my word for it. Everything that you've heard here, I always encourage skepticism. The productive, good kind of skepticism, where you're not just being a skeptic to be a hater. Not that I give a shit, but you're being a skeptic because you want to go back and check for yourself to see if the stuff that I've been showing you is actually legit. Because in the process, you will show yourself. And that's how you develop that confidence and you get better at your trading. So thank you for going back and checking. Do not fall into the trap of listening to someone or reading something or watching something and thinking that you've got it now. Go and actually apply. Apply it. Don't use a live account. If you're using a live account, drop your risk to a stupidly low level where you don't care. The important thing is you want to see how you can be consistent with this. All right? I will never DM you first. Anybody who is DMing you and claiming to be me is not me. The Telegram link is in my bio. You can join the group there. Inside of the group, you will notice something about mentorship. I'm shutting it down end of this month, right? No matter who's in there, I'm shutting it down end of the month. And it's only going to be, there's 4 more spaces now. So that's all there is to it. However, you don't need the mentorship if you just keep coming for the lives. More than enough. More than enough for you. You don't need the mentorship. What else do I want to say? When you get in there, please read the pinned rules as well. Respect them. Don't DM me directly unless you're talking about the mentorship thing, which is a one-on-one. That's the difference between what I'm doing here. The time I give you here is for free. Any other time that you want from me is not for free. And I will not be shamed or bullied for charging for my time. You can't do that. I don't care. That's your opinion. What else do I want to say? Those of you who are going to DM me on TikTok inevitably, please don't just say hi and don't just leave a compliment. As much as I appreciate your compliments, if you do not leave a trading related question, I'm very unlikely to open your message. Okay? Not because I'm trying to be a snob, but because some of you have taken advantage of that and have come to DM me some very interesting things. Anyway, that's about it. The details for the mentorship are in my Telegram. Tick Takers. You can click the link in my bio. Click the link in my bio. You would like to request V75 for Monday. Yellow Elephant. Hi, you're here. We'll see how that goes. I'll think about it. Greg, you're welcome. Whenever you're ready, but like I keep saying, guys, the lives are always by 11 p.m. UTC plus 1, GMT plus 1, West African time, Nigerian time. No daylight savings, so the time doesn't move around. It's always 11 p.m. where I am, unless I've traveled. I'll let you know. 6 ticks, thank you. Thank you so much. Malusia, you don't have Telegram. DM me on TikTok then, and I'll provide you with the details. All right. But DM me, please don't just say hi. DM me with your query. Okay? Okay, people. Thank you very much for being here. I appreciate you. I appreciate your presence. And even as I have given to you, you have given me as well something by being here and by listening, because I love to teach. That is the core of who I am. And the fact that you are here, I don't take it for granted. I appreciate every single one of you. Thank you for showing up. Tomorrow's Friday. There's no news event per se. Trade well if you're still trading. Those of you who have already hit your targets for the week, close your laptop, have a good time, okay? Just chill. And I'll see you guys the next live, 11 p.m. UTC +1, Nigerian time. May the markets favor you. Good night.